Bank earnings season is in full swing after three of the nation's biggest institutions easily beat expectations. JP Morgan Chase, Wells Fargo, and Citi did it on the back of net interest income, spurred by the Fed's aggressive rate hike campaign, which in turn allows banks to charge more interest for loans. While we're waiting on other major players to report this week, there's increased focus on regional institutions after the failures of Silicon Valley Bank and Signature Bank. Specifically, First Republic, which faced a liquidity crunch in March, will report earnings on Monday, the 24th, after its stock price fell nearly 90% since the start of the year. Joining me now to discuss this all is the Fed guy, Joseph Wang, CIO at MonetaryMacro.com. Joseph, thanks for being here. Look, we've seen Bank of America, Goldman Sachs, Morgan Stanley reporting this week. Are you expecting high interest rates to help the bottom line like we saw with the other banks last week?
Yes, that seems to be the consistent theme here. So the Fed hikes rates aggressively, and now all those banks are having loan assets that yield much more than they did before. So that's helping. That's been a consistent theme in the big banks and in the regional banks that reported today, Monday. So I expect that to be the same theme going forward for basically all the regional banks.
Are we going to be seeing any kind of cracks here? It seems like we've had this big banking crisis, and even Jamie Dimon over at JP Morgan Chase has said that he doesn't think it's over. Are we expecting anything to come out of the earnings season when it comes to banks that show us that something's still off here? Or do we think that it's abated?
That's the big question on everyone's mind, especially because how the banking sector fares is going to influence monetary policy. Part of the reason that the Fed is indicating that they might not hike anymore and the market is pricing in rate cuts later in the year is because there's a perception that there may be a crisis in the banking sector. But from the indicators that I watch, I think that it's basically over. What I watch is basically weekly data published from the Fed about loan creation in the banking sector. And as of the most recent data, it looks like the banks have actually, both large banks and small banks, have begun making loans again. Overall, I think the message is that there's definitely no panic, there's no doom. Things may be slowing a little bit as the Fed would like it to be, but things are still fine.
Do you think that the same is going to be said for First Republic? It seems like that one regional bank that is still struggling to gain footing following the collapses, the second and third largest bank collapses in the country. What do you think we're going to see next week?
We already had M&T Bank report their earnings Monday today, and Schwab as well. Those are regional banks that many people were focusing on, and their results were very good. They did have some deposit outflows, which we all know, but they seem to be manageable, and their stocks are up notably today. Now, I expect most regional banks to be in their situation, but as you rightly note, First Republic, though, might be a bit more challenging. Now, let's step back for a moment and look at the U.S. banking sector as a whole. The U.S. has over 4,000 banks. If you have 4,000 banks, some of them are not going to be managed well. We know Silicon Valley Bank obviously was not, Signature Bank was not either. And one of the banks that was not managed as well, but not as poorly as Silicon Valley Bank, is First Republic. So there may be some trouble there going forward.
I'm curious, Joseph, are you surprised that we didn't see more consolidation of banks? You mentioned 4,000 banks in the United States. I think that when this all started to unfold, there was a lot of talk here in Wall Street that we were going to see a lot of consolidation. That doesn't seem to have happened yet. Are there deals on the horizon?
Well, we had a little bit of consolidation. I think I believe one of the smaller banks purchased a lot of assets from the FDIC of the failed banks. But let's again take a step back. So pre-Great Financial Crises, we had about 6,000 banks in the U.S. Now we have about 4,000. So gradually there is some consolidation. One of the things that I've heard as well is that the regulators don't really want the bigger banks to get even bigger. So there might be some regulatory constraints that are preventing the mega banks from gobbling up some of the smaller banks as well.
We're always trying to track the trends that are going to be happening, whether it's a credit crunch or specifically, I wanted to talk to you before we even get to that about possible overexposure to the commercial real estate. That's big talk right now that banks might be too overexposed to an area that seems to have quite a bit of cracks here. What can you tell me about it?
Yeah, that's definitely a focus in the market right now. So first off, I'd like to note that commercial real estate is a really broad sector. So you have multifamily, you have hospitals, you have malls, and you also have office space. when you look across the commercial real estate sector, office stands out as a sector that's in a lot of trouble. Obviously, things have changed post-COVID, so a lot of people are not going back into the offices. And so those people who own office buildings, they're in a lot of trouble. And the people who lent money to the people who own office buildings, those lenders might be in trouble as well. One thing interesting in the commercial real estate sector is, as many people have noted, is that a lot of the smaller and regional banks finance commercial real estate. So there's been some concern there. But I'm not as worried for a couple reasons. First, as we know, that commercial real estate, many sectors, office is not good, everything else seems to be okay. But the second thing that's not as often mentioned is that real estate prices have gone up tremendously over the past few years. Office space is going to take some big haircuts, but I think most people in this space are pretty sophisticated and diversified. So they're going to take some losses there, but it's not going to be their whole portfolio.
And then lastly, let's talk on this credit crunch. You mentioned that loan activity is starting to tick back up. So from your perspective, is this something that's already in the rearview mirror, or are we still watching a tightening credit standard in the United States?
Now, as we've been discussing, the US has a few thousand banks, and some of the smaller banks may be in a more difficult situation, so they may pull back a little bit. But that I wouldn't call that a credit crunch for the banking sector as a whole, since overall the data shows that banks continue to make loans, and the big banks who are count for the majority of assets in the banking sector are okay. So banks like First Republic, they may be in some trouble, but they're not representative of the broader banking sector.
We're talking to the Fed guy, Joseph Wang, CIO at MonetaryMacro.com. Joseph, thank you so much for your time today.
My pleasure.
At Straight Arrow News, we don't care if you're liberal, conservative, or independent, because you deserve the facts and the unbiased truth. So join us in our mission at straightarrownews.com.